Hi, everyone. I'm Denise Garth, Chief Strategy Officer at Majesco, and you're listening to the Future of Insurance Industry Leaders podcast series. Follow along as I interview the best and brightest leaders in the insurance industry and InsurTech landscape to bring you the latest in digital transformation, innovation, industry trends, challenges, and opportunities, as well as next-gen technologies. We use our experience to anticipate what's next without losing sight of what's now. Stay tuned to find out your next now. Welcome, everybody, to today's Future of Insurance podcast. I'm thrilled today to have David Gritz, Managing Director of InsurTech New York, joining me. David and I have gotten to know each other since the beginning of InsurTech back in the old Silicon Valley Insurance Accelerator days. So, David, welcome.
Thanks for having me, Denise, and always good to share a conversation with you.
Same back at you, David. We always say that this is a small industry and it's a small community and everybody knows everybody, but it's always surprising to me how many people don't really know some of us. I always like to have my guests give a little bit of background and what your current focus is. So, David, over to you.
Sure. So as a brief way of background, I got into the InsurTech space in 2015. I was part of a workers' comp captive based in Vermont. They were having some challenges, so I was recruited to help turn them around. And basically, we built our first InsurTech startup called Zero for zero lost days of work, and essentially focused on helping the companies within the captive to prove their risk exposures and change the way they do business with behavioral-based safety. We grew that business, and then we sold it to our reinsurer. And then, I started working with the team at the Silicon Valley Insurance Accelerator, Mike and Natalie. I think that's where Denise and I originally met, helped them with some of their events and the research that they did with the carriers. And it was a really great experience, but living on the East Coast and having to ferry back and forth to Silicon Valley, while it's fun at first, it's definitely not a sustainable lifestyle. So, I realized that wasn't the kind of march that I wanted to do all the time. So I met my business partner, Tony Liu, and we kind of had the inspiration, like, why not do something on the East Coast? So InsurTech New York was born, and we've really become more than just, I would say, like an events organization. We definitely do some major events like our spring conference, where we expect to have 1,000 people. But since then, we've really developed a number of programs. We have a global InsurTech competition, which the finalists will be presenting at our conference. We run a corporate innovation program where we work with carriers and brokers to help them find startups to work with. And we have a incubator program where we incubate startup MGAs to essentially, go through the foundational pieces to go from idea to first policy sold. And, now we have a venture fund where we invest in seed stage insurtechs and now have 16 portfolio companies.
It's been kind of an amazing journey for you in the growth of InsurTech New York. And I know one of the areas that you're really focused in on, as we are, and a lot of people in the market, are MGAs, because it's one of the hottest areas of growth and investment. It's a market that we've done some research and you've done some research. We've kind of done different angles of that research with regard to their focus, their priorities, their technology. But you did something really unique, Jolene, I think it was with Resource Pro, and you looked at 50 different startups and you called them market makers. What do you mean by that, David?
Yeah, so the reason why we looked at the startup MGAs is because there are some great organizations like, WSIA and Target Markets, and, they've kind of created this foundation where there's a lot of information being passed back and forth on established MGAs or traditional MGAs. But in terms of, startup MGAs, those have been really formed in the last 10 years and are kind of digitally focused. We found that there was very little information about, which reinsurers that they worked with, what was their business model in terms of distribution, did they handle claims? And that's really what our research focused on. And in terms of like the market maker concept of it, one of the things that I would say surprised us probably more than other things is the actual proportion of MGAs that actually were involved in doing their own filings or even taking risk, which was more than half of them. Because if you think about where some of the MGAs had originated from, like if you think all the way back to the 80s, most of the MGAs were agencies that became specialists. So let's say you were really good at doing taxi and limo in New York City, maybe you would have better underwriting capability than the carrier underwriter, and that would be, the MGA that you create. Or maybe you're really good at property in Florida, kind of similar concept. But many of the insurtechs that we interviewed and surveyed for our research, we found that they were actually creating new products that either didn't exist with any carrier in the market at all, or essentially they were responsible for working with the carriers to do filings with the states, whether it's admitted or actually working on the rates and forms if it was an excess and surplus lines product.
So what were the 2 to 3 key takeaways for MGAs that you found that were crucial for success with these market makers?
Yeah, so I think probably one above all else was, how important distribution was to their success. So we found from some of the interviews that the more or less like base level expectation from capacity providers that the MGAs reach 5 to 10 million in gross written premium in essentially, 2 years. And, based off of our data, we have this kind of volcano type of looking chart where it shows the breakdown over time. And roughly about, half of the MGAs, maybe if you think about all the way up to 20 million in premium, I think it was like 13% of them get there within the 2 years. So that actually kind of beat my expectation, but there are, a fair number that did not meet that. Let's say like a third of them did not get to, the 5 million in premium within 2 years. So I think getting your distribution right from the very beginning is extremely important. And our data also showed that there's 100 different ways to get distribution. So some of them were using embedded, some used wholesalers, some used retail agents and brokers, some went direct to consumer. And many of them used more than one modality, like 2 or 3 modalities. And even across the number of agents and brokers they distributed with, some were using between 1 and 10, others were using over 1,000. And it's hard to say like what was the rhyme or reason behind a lot of that strategy, because a lot of that happened in the heads of the founders. We didn't interview all of them. But I think generally speaking, the founders that came from an underwriting background and that they focused on getting their distribution set up very quickly, they were more likely to be successful. And, based off of some of those success metrics, I was actually kind of really proud of them. So 26% of the startups were self-funded, so they didn't need external capital. And, of those startups, I think almost it's like 45% of them either were profitable or were burning less than 100,000 a month, which is like a pretty good mile marker from VC or private equity standpoint. It means that they're probably going to be profitable within the next 1 to 3 years.
That whole concept of distribution, some of the research that we've done with both consumers and small, medium business owners, which obviously the MGA market really focuses in on, it's really about market reach, but it's really meeting those customers when and where and how they want to buy insurance too, which I think is something that the MGAs have been really kind of innovative at, is really kind of looking at those different distribution channels to meet people where they want to buy insurance and where their need is.
No, absolutely. I think it's really important to be able to do that. For example, we have a portfolio company based in Canada and they focus in the extended warranty space. And at first they were like, we're going to do everything digital, like it's going to be on the website and that's how we're going to sell. And then they realized once they got a customer of a mattress store that people actually like to go into the mattress store to test the beds. Like that's something that you probably can't do virtually. So, at the point where you're making a purchase decision in person, you still need to be able to buy warranty at that point. So they had to create software that could be used in combination with the point of sale systems, which is, not something you would necessarily think is a role of an insurtech. But at the end of the day, they do need to meet the customers where they are. And in the case of a mattress store, it is in person sometimes or many times.
One of the other aspects that they're really MGAs I found is they're really quite innovative around products. So what kind of products have been really successful for some of these different MGAs that have really been the market makers?
Yeah, give you a couple examples of products as like pretty successful MGAs in terms of growth, and then I can share, maybe some of the emerging ones that were in our MGA labs. I think those that kind of tackle the unheard areas of the industries are doing really well. So like Cover Whale is probably one of Everspan's like most successful MGAs that they fronted for. And, they've grown really well in that trucking space. And there's, several others. Narvana is also in that space. They've kind of backfilled where the carriers were pulling out and kind of creating a hole in the market. Similarly, a lot of carriers don't do super well within the retail restaurant space. And good startup in that space is a company called Rainbow. They recently just raised, I think it was like almost a $10 million Series A. It's just an area where carriers tread lightly, but if you really get to know it, you can do really well. And then the other area that we've seen is within that kind of small business line. So there's a handful of companies that are in that space. So whether it's Vouch or Founders Shield or Next Insurance, those are kind of the players that have really gotten a lot of market share really quickly. But there's even, emerging players like Drafters, which is based in Texas, and they focus on just kind of the architects and engineers. So I would say, some of those areas that are either dislocated or, very receptive to people that want to have a digital experience have been doing well. In terms of some of the newer classes that we've seen through our MGA lab, that's kind of, exciting to us and has a fair amount of potential. So, we had a company in the MGA lab that focused on fertility benefits called Flora. So essentially helping women in their 20s and 30s to secure their ability to have a family, whether they're ready now or, they're planning for the future. And they're one of many. I think there's also companies like Juniper in the UK that have kind of a broader mandate around fertility that's not gender specific. But we see that as like a tremendous growth area in the future. We've had a number of companies in the supply chain and logistics space. So one of them was called Autonomy in our MGA lab, and just very simple concept. In freight and shipping space, most of the coverage exists around the peril of actual loss or damage, but it doesn't cover around the peril of time delay. So they have a simple proposition. We're going to cover for air freight your loss according to time delay. And they've been able to really attract some major brands globally to start to work with them. And I think there's a lot of untapped opportunities, everything from, last mile. We have a portfolio company called Anansi that does essentially shipping insurance for e-commerce merchants, all the way back to freight from one place to another with autonomy, or even there's a company called StartSure that was just acquired, and they cover your merchandise while they're sitting in the warehouse.
What a diverse set of companies with products that are really meeting a very eclectic set of risk out there in the marketplace, or need to have some kind of coverage. It's the possibilities, quite frankly, are endless, it seems like.
Definitely. Yeah, I would say that's why when investors, last year or the year before started to stray away from MGAs, because maybe some of them didn't do as well in the public markets or some of them didn't grow as much as they could have. I would say we were very much a contrarian. We doubled down. I think basically half of our investment portfolio is either directly digital broker, an MGA, or someone involved in the kind of distribution of insurance products. And our firm belief is that essentially, InsurTech MGAs are kind of that innovation lab that carriers can partner with, provide reinsurance capacity to test out markets before they're ready to ultimately make the market or to grow stepwise into those markets.
So technology plays a big part into the success, particularly those that are developing their own products, doing the underwriting, and in some cases doing some of the servicing and bringing those products to market, with the different channels that they've got. And that really requires, I think, a different set of technology, particularly if they're going to be on a growth path. Sometimes in the past, from an MGA standpoint, if they were relatively small, they might have operated with spreadsheets as an example, because they were pretty niche and et cetera. Or they might have operated with an agency management system. increasingly a lot of the MGAs that really have very strong growth plans and are really trying to bring some things to market that are going to be really differentiated are really looking to technology and more of what I call the traditional kind of core platforms, the policy billing and claims. Maybe not so much claims if they TPA it, but at least policy and billing so that they can really kind of engage. How have you seen technology kind of become a key factor of success over the last 3, 4 years as you've worked with this portfolio of MGAs, David?
So what I was seeing is really important for technology is essentially the existing solutions, whether it be like yours, Majesco, or even some of the comparative raters, is that essentially it's enabled startups to get started faster. So if in the beginning, call it 2015 to 2018 era, they're like, oh, we're going to build our own policy admin system. Now, if a founder pitched to me and included that in their investment deck, I would be like, why are you wasting my money on that? Why don't you go and do that? And then you can ask me for money after that's done. But I don't want you spending your money when other people have built like really great, robust systems that are scalable. And not only that, I think a lot of founders think about product that they have today, but many successful MGAs are going to be multi-line products, and it's kind of stupid to think that you're the best one to maintain that versus a company that's all they do. So what I've seen is like, the core platforms are very important to allow the startups to start faster when they can just pick one off the shelf and customize it. But then there's become a lot of other ancillary pieces that really help them be successful, whether it's the broker portals, the submission systems that help them to kind of introduce RPA from the very beginning into their submissions and making it easier to work with agents. And then, there definitely are startups that handle claims themselves. I think a bit more than a third were actually handling themselves from the survey. I think having, a system that you can use to jumpstart that. And, even if you are working with a TPA, I think it's really important to supervise some of those, higher severity types of claims because, it's definitely going to come up with your discussions with the reinsurer. They're like, well, what is this? And if your only answer was, oh, the TPA is handling it, it's probably not going to be sufficient.
No, not at all. Yeah, it's really a requirement for real profitable growth, I think, going forward, especially if you are really looking at the data to manage the business, whether it's an underwriting perspective or really managing the data to make business decisions. Being able to have access to that data, leverage it across the different areas of the insurance value chain is more important than ever, and technology is required.
One of the things that was really cool to me is a company haven't announced the investment yet, but we just committed to them, the founders and actuary, and they actually are able to by individual producer in their company figure out what that producer's loss ratio is so they can determine how productive they are, not just from sales but also from a loss adjusted perspective, even break it down. I mean, I guess most startups can do this, but they break it down by state, but then also the progression in each state, because some states are newer to their portfolio or don't have much concentration, and depending on their different channels, because they have at least 3 or 4 different channels, they can say, well, in this state, we need to do more of the channel that tends to have a lower loss ratio if we're kind of going above the average in that state.
When I look back over the last 10 years, David, when you and I met each other back in 2015 at the start of InsurTech, it's been 10 years and we're really now approaching a new phase in a new decade of growth and investment in InsurTech. You've done some interesting research on this. Kind of talk about what you're seeing about what kinds of organizations are really doing the greatest investment and ownership stake. What are the positive, negatives, or implications of this? And how has that changed and what defines a good investment?
By dollar volume amount, I would say the investment is roughly shared between traditional, carriers and brokers that invest out of their CVC or their balance sheet, based off of any given, month or quarter. There's between 80 and 90 different entities that are insurance companies that make investment. And I think that forms a very solid foundation. So these are groups like, Liberty Mutual Strategic Ventures, Allstate Ventures, Nationwide Ventures, some balance sheet investors like Homesteaders Life or Arch. And, I think that's really healthy because to have corporates that can, support the industry is really important to have, long-term viability of change and improvements in the industry. And it means we're betting on ourselves. And then, of course, beyond that, there's really the InsurTech investors. So groups like us, IA Capital, EOS, Sandbox, Anthemis, and they generally have pretty good focus in the space. If you look at it, most of them are doing anywhere between, 3 and 10 investments a year. Some of them kind of split between other areas, like, IA Capital also is in the fintech space, and then 630 is also in the digital health space. And I think that's kind of a healthy cadence. But what we're really missing that's robust that I think exists in other industries is the foundation of angel investors that start at the very beginning, these pre-seed companies, they help them get them off the ground. And yes, there are some angel groups, like we're very friendly with the InsurTech Association run by, Bob Sargent, and they have an angel group called IGN. So we always look through their deal flow and collaborate and send them deals. But beyond that, there is not a really strong basis of angel investors. So, like, based off of the universe that we map, there's probably somewhere in the range of like 30 to 50 individual active angels, which, if you compare that to like the total number of people on angel list, which is probably over 100,000 that are active, or if you compare that just to fintech angels or, e-commerce or biotech angels, there's a lot more volume of people. So I think as an industry, we need to get more involved. We need to encourage our executives to bet on their own business's future. And, when their bonus is coming up in March or April and say, hey, well, what if I took just like, 25% of my bonus every year or 50% of my bonus every year and I invested in like a handful of insurtechs? What could that do for my own personal development and for the industry? And I think if we could get another 100 to 300 executives doing that, that early stage would have a lot more support. And I think we would have a more vibrant ecosystem on the early stage.
Really fascinating. I hadn't thought about it in terms of the angel investors, but that really does limit the development of technology or insurtech companies, MGAs, whatever it may be. If we don't have those early seed, it is really dependent on people putting up their own money to be able to really get things started.
It really creates like an access problem because if
Yeah,
you're not a founder that used to be a senior executive, or you didn't have a previous exit, or you don't have, wealthy friends and family, then essentially you're stuck in this limbo where you basically have to grow really slowly and bootstrap. And, you don't have the same access to the market as, other people do. And, I think it's one thing, the question in our industry, do we want to have fairness of access for early stage, or do we not care? Like, is it good enough that, if you were a senior underwriter at Travelers or like Liberty Mutual, and now you can go ahead and start your company, then that's all we want? Or do we want to have, a diversity of voices at different stages and paths in their career?
yeah, absolutely. So as we enter this new phase, what's going to be different than the past decade, at a high level from your perspective, David?
Yeah, so I think, if 2015 to 2024 was about this kind of foundational level, so building technologies to help enable the next evolution. So, like, we talked about a lot of those technologies that help MGAs. I think, 2025 to 2034 is really going to be about new underserved niches. And it's also going to be about creating really productive carrier and insurtech partnerships. So I think in the past, a lot of the innovation groups had like latitude where, hey, if a partnership happens, like great. If it doesn't, I still keep my job. I think these days now people are going to be judged on the velocity of the partnerships and also on like how deeply they penetrate into the core part of the organization. And, I think one of the great things about generative AI and some of these new technologies is that they don't require the entire workflow of a business to change. Like, if you think about last generation, like the robotic process automation, it's literally changing how people do their jobs. These are mainly additive processes opposed to, subtractive or transformative. So I think we're switching from a transformation to an evolution space, and then we're going to be creating opportunities to, I would say, lower the price of coverage for new niches. So whether it's, offering disability to lower middle income, or it's creating new categories like fertility benefits, or it's even, helping support areas that are oftentimes ignored. So if you think about mortgage insurance, it's really just tailored to sell to like major government entities and large groups. But, why not create an environment where we can have something broader that ultimately replaces like traditional mortgage PMI. So, I mean, that's just one example, but I think there's tons of underserved markets that can be tackled now that technology is easier to get those ideas in place.
Building on that, if we kind of look at investment and innovation and where there's been risks or lines of business or new ideas that have really been somewhat forgotten, let's talk about some of those. So you talked about disability. How does that need to change? And then let's talk about flood. And wow, that one's become a real high priority with everything that's happened in the last year from the various different hurricanes or the wildfires and then rain coming in and creating a real flooding kind of situation. Both of those have been relatively not a lot done with in decades, David.
To kind of tackle one at a time. So on the disability side, what's been unfortunate is if you track the trend, over the last 20 years in terms of people that had access to disability either through their employer or bought it individually, it was almost 30% in the upper 20s, and now it's in the upper teens. And this is the product in an economy where essentially you think we're going kind of back to the 1920s where essentially the upper 20% has the majority of the country's wealth and the kind of the lower 50% is losing the portion of the wealth. You need a backstop. And, I'm not going to be here and advocate, we need to be like Europe and set up a social safety net, but we already have a great product. Disability helps people when they lose access to their income because something happens to them in their life. And I think if more of the population knew and understood how disability worked and had access to it, and obviously the more access, the less the premium because it's a broader base of people, then I think that's a fundamental product that, government should be advocating for. And, we have a portfolio company that does, straight through processing disability in the UK. They're looking to come to the US market. So we're very excited about that. But actually, the UK government is actually taking steps to make that one of their public goals. And I think the US government could learn from that and advocate for it, not necessarily saying they need to subsidize it, but they can provide the education to raise awareness about it.
What about flood then?
Yeah, so in terms of flood, I think, most of the focus on flood has been those coastal properties and places
Yeah.
where, it's essentially mandated by the mortgage companies. But I think the piece that's missing is, rivers flood, lakes flood, sometimes areas that have no bodies of water flood just because of rainfall, right? And I think the stat is from one of our MGA lab companies called RIC Platform that like 99% of all counties have incurred flooding in the last 100 years. So if that's the case, then, everyone should be really thinking about what they're going to do to mitigate flooding. So, build more resilient houses or, buy protection. So you're not caught like the people in Asheville, North Carolina, where, they didn't think it was even possible. And then the entire community was devastated.
Yeah, it even happens. I know it's happened here in the Midwest, David, is in the spring when the ice is starting to break in the rivers and it can get jammed up and then it causes this massive flooding as well. And it happens just so rapidly. Areas that would not normally flood are just devastated as a result of that. So I think the idea of flooding, there are different times of the year that because of other events, it creates more of an issue around flooding that really needs to be addressed.
Yeah. Well, and I think the other thing that where InsurTechs can play a part beyond just the coverage side is like the emergency response, right? Like
Oh, yeah.
almost all flooding damage happens because the water sits. If you can get rid of the water right away, you can definitely mitigate the harm. I mean, from personal experience of having a busted pipe in my house, I understand how quickly you can, if you put the effort in, get the water out. But as soon as you let it stagnate is really where substantial damage comes into place.
So one of the other areas that I think is really fascinating, and I kind of identified it this year in my 8 trends, was protection as a service. And that's really where I think parametric falls in, parametric insurance. And last year I talked about embedded insurance, and it is gaining some steam as well. Talk about what you're seeing in both of those, because I still don't see a lot of traditional insurers really focused in on the opportunities here to really help people that can't afford maybe the full kind of policy of something from a risk standpoint, be able to have access to some element of protection in the event that something happens, which is really what parametric has the potential to do.
Yeah, no, I think parametric is great for a lot of those like low limit policies that can ultimately introduce something new. So, a couple examples to pull out here. One is one of our MGA lab companies called Sola, and they have a tornado deductible buy downs. A lot of the Midwest insurers have been raising their deductibles for wind damage to 15, 20,000, which, for, the middle class average homeowner is more than they personally can you'll cover, and ultimately prevents them from getting full recovery. So Sola allows them to ultimately buy down that deductible, and their parametric trigger, they get payouts, I think, within 2 days, and basically allows them, based off of the strength of the storm, to get the coverage that they need for that deductible. They also have a wind and hail deductible buy down that they're introducing as well. And that's one category on the property side, but I firmly believe that it can expand to other areas as well. So we have a portfolio company called DLT Alert that focuses a cyber parametric cover. And what a lot of people don't realize about cyber is, like, just because you have the policy doesn't mean that you're going to get paid out right away. Oftentimes takes anywhere from like 2 to 5 months to adjudicate a cyber claim, just because of all the things that need to be investigated. But if you're a retail store or a small business and you can't run your business because your technology is broken, you might have more losses than you would with a property claim. So that's where DLT Alert comes in, and they pay out within the same week, and they make an offer proactively because they're connected to your IT systems, and essentially help to mitigate the cost for the ultimate insurer because they're getting you back online much faster. So I definitely see a lot of areas developing that way. I would love to see something on the liability side of things. So imagine, like a parametric auto cover where if you have a personal injury, then, it pays for your physical therapy. And I haven't seen any startups that have done that yet, but it definitely could really help insurers, because one of the biggest challenges they have is, like, it's a personal injury claim, and now the people want to go out and rush to the ambulance chaser attorneys. It just makes it more expensive to everyone. But if they knew they had this parametric physical therapy, get back together coverage, then they wouldn't have to worry about like calling the sign on I-95, or pick your highway.
Isn't that the truth? So, David, this has been a fantastic conversation. What I like to do at the end is to have everybody talk about what's one word or phrase that you would use to describe the future of insurance and why.
So the phrase that I would pick is really about mitigation. So if you think about insurance from history, it's all been about risk transfer. And I think in the next 50 to 100 years of the insurance industry, there's going to be a shift from just transfer to mitigation. There's a lot of, frightening things on our horizon, whether it's very esoteric perils like a volcano in the Pacific Northwest, or like the lahars from melting ice there that could really devastate communities. The more that we can do on mitigation, whether it's cyber risk, it's property risk, it's liability risk, the more stable we're going to have as a world, and the more profitable we'll be as an industry. So I think the more that insurers can think proactively about how to mitigate risk, the better off we will be as a society.
David, thanks so much for taking the time today and talking about what you're doing, not just in InsurTech New York, but also the portfolio companies and the innovation that's going on. I know a lot of that will be profiled at your upcoming InsurTech Spring Conference, April 2nd through the 3rd in New York at Chelsea Pier at Pier 60. And I'm looking forward to being there as well.
Awesome. I'm really glad to have you.
Yeah, it's going to be a great conference. And I think the stuff that your portfolio companies are doing, there's a lot of exciting stuff there that's really needed in the marketplace. So congrats on that, and looking forward to hearing more.
Thanks, Denise.
Thank you. That's it for this week's episode of Future of Insurance Industry Leaders podcast. Subscribe to our market leading podcast series, available wherever you get your podcast from. Thank you for listening, and be sure to tune in